Welcome to the Deep Dive, the show where we cut through the noise and deliver the essential insights you need. Have you ever felt, overwhelmed trying to make smart, high-stakes decisions? Especially when the information feels dense and the stakes are really high? Well, today we're peeling back the layers on a topic that could fundamentally change how you approach one of the most dynamic environments out there. We're taking a deep dive into what it truly means to coach your trading business. Think of it as uncovering how to approach trading, not just as an individual making trades, but with the strategic mindset and disciplined execution of a savvy entrepreneur.
Exactly. And our mission for you today is pretty clear. This isn't simply about market strategy or, predicting price movements. At its heart, it's really about the vital psychology of managing risk, making truly informed decisions, and building rock-solid resilience in a constantly shifting environment. We're going to show you how applying sound business principles to your trading can profoundly transform not just your performance, but how you think and feel about your entire trading journey. It's kind of like becoming your own best coach.
Yeah, that's a great way to put it. So let's unpack this core concept. A trader, at their very core, is a business person. Just like any entrepreneur launching a new venture, you're dealing with overhead, right? You need to generate consistent returns, and you're putting your valuable time, effort, and capital at risk. It's far more than just a hobby. It's an enterprise.
And what's particularly insightful here is that this business concept goes beyond just making money. It's about optimizing those returns, yes, but critically, it's about managing risk at precisely the right moments. It's also about focusing your energy on activities that, truly provide the best returns. You're not just executing trades, you're doing the right things and you're doing things right. This shift in perspective, it's a powerful self-coaching tool. It transforms your whole approach.
I completely agree, and that's something that really comes through in the material we looked at. When you think about launching any new business, one of the foundational pillars is strategic capital management. The sources really hammer home why adequate startup capital is absolutely paramount in trading. Without it, you quickly burn through cash. You just can't survive those inevitable learning curves.
Right.
And you simply can't weather the slumps or market changes that will occur.
Yeah, inevitably.
And that inevitably leads to immense stress. It forces you to cut corners on essentials, like critical data subscriptions or maybe robust redundant systems. Ultimately, that eats away at your edge, your distinct advantage in the market.
That's a huge risk.
That's precisely why simulation platforms are so crucial. This is where you can realistically test strategies, get a feel for the market without risking actual money. And crucially, without dealing with the intense psychological pressures of real loss or, overconfidence.
That psychological buffer is key.
It allows a beginner to simply focus on the mechanics, on pattern recognition, and on building discipline without that emotional burden. The principle here is pretty much non-negotiable. Prove you can earn consistent money in practice trading before you assume even modest real risk.
It's like a business proving success with one store, right? Before they even think about expanding.
Exactly.
And if we connect this to the bigger picture, when the aim is truly trading for a living, well, far more startup capital is needed. Our sources suggest it's often well into the six figures just to sustain a living from realistic returns, not based on optimistic fantasies for business plans.
Right, not just hopes.
Yeah. Undercapitalized traders who try to generate big returns by taking overly aggressive risks, they often sustain grievous losses that cannot be surmounted. They just don't have the psychological or financial resilience to weather those inevitable rough patches.
So the immediate takeaway for you, our listener, is this. Long before you even contemplate trading for a living, your focus should be squarely on achieving trading competence. That means consistently breaking even after accounting for all your costs. That's your first real business milestone.
That brings up a really important question then. What's the smartest way to start building that competence?
Well, one of the most astute business decisions you can make in your trading, and this is a key coaching cue, is to begin with an account small enough that it would not impact your family's lifestyle if I lost every penny.
That sounds incredibly sensible.
It is. It's incredibly powerful because it fundamentally removes the pressure of profitability demands during that crucial early development phase. It allows you to make mistakes and learn from them. It's a huge psychological relief. It lets you truly focus on building skills rather than that constant anxiety about losing money. Okay, that makes perfect sense. So once you've got your capital sort of thought through, what's the blueprint for this new enterprise? We're talking about crafting your trading business plan. We'd ask you to consider,
Yeah.
what are your actual goals? It sounds straightforward, doesn't it?
Yeah, seems obvious.
But our sources point out that many traders are surprisingly fuzzy about this. They don't clearly differentiate their objectives. For a beginner, your goal is simply learning the ropes, internalizing market patterns, practicing execution and risk management. As we mentioned, this can be done with little or no capital. You mainly need a solid learning plan and a simulation platform.
Right, that initial stage.
Then there's the avocation. Maybe trading is part of diversifying your savings, alongside a primary income perhaps. Here, the goal is to make more than the riskless rate of return after expenses, with a keen sensitivity to risk-adjusted returns. But if you're trading for a vocation, aiming to trade for a living, that's where it becomes a true business. What precisely will you trade? How will you trade it? How much proven experience do you actually have?
Right.
What are your fixed overhead software, hardware, commissions, data,
Are
education?
those real costs?
Yeah, and how much can you realistically expect to make? What's the income variability look like? These questions demand hard data based on experience, not guesses or hopes. This is where that self-coaching becomes intensely data-driven.
And what's crucial here, absolutely crucial, is that before you even attempt to trade for a living, you need to know several essential metrics. Think of these as your trading business's vital signs. Your average size of winning trades, the average ratio of your winning to losing trades,
Okay.
the average percentage of winning versus losing trades, and the average variability, or you could call it volatility, of your returns per day, week, and month. These aren't just numbers. They really tell the story of your performance.
Exactly. These metrics let you truly look under the hood of your trading. They're what help you distinguish, say, normal drawdowns from troublesome slumps, and they help you identify those subtle shifts that happen because market conditions are always changing. It's like your internal accounting system, giving you real-time feedback on performance and helping manage the psychological impact of that volatility.
Precisely. And a highly practical exercise our sources suggest is using forecaster tools. I mean, even simple paper-based or spreadsheet simulations can work to plug in your own historical data. This helps you visualize how returns will vary with volatility, gauge your personal tolerance for drawdown, and really understand the expectable runs, both the good ones and the bad ones, over many, many trades.
So it prepares you mentally.
Yeah, it helps you mentally and emotionally prepare for the inevitable ups and downs, which is just crucial for psychological endurance.
It also lets you run those vital what-if scenarios, like what if your average winning trade shrinks because the market shifts?
Good question.
Or what if your winning to losing ratio declines? What if you, the trader, just lose discipline for a bit? These simulations give you a strong sense of what to expect, and maybe more importantly, help you deal with business adversity if you've planned for it in advance. That makes you far more resilient when those tough times inevitably hit.
And this really reinforces how you coach yourself through those tough periods. The key is through detailed metrics. They allow you to identify periods of underperformance as quickly as possible and, just as importantly, highlight what you're doing right and wrong, informing your self-coaching efforts. This data-driven self-awareness, it's fundamental to psychological endurance and, well, continuous improvement.
Okay, let's pivot a bit to another core business principle: diversification. Think of, say, a coffee house that decides to add pastries to its menu. Now, adding tea might not truly diversify because people often buy one or the other, right?
Right, they might substitute.
But pastries, they can increase the average check size, attract new customers who just want a snack. It boosts overall profitability and protects the business if coffee sales slow down. Those are truly diversified profit centers.
Good analogy. And this applies directly to trading. When you trade different markets, different time frames, different patterns, you're essentially generating multiple potential profit sources. This protects you when markets inevitably shift and maybe place any single idea or pattern into drawdown mode.
So if one strategy isn't working,
Exactly. If one strategy isn't performing, others, ideally uncorrelated ones, can pick up the slack. That significantly reduces the psychological strain of relying on just one single approach.
a crucial distinction, though, comes up here. True diversification means providing a truly independent and reliable income stream. It's not just trading, say, the Dow and the S&P 500, which are obviously highly correlated.
Very correlated, yeah.
And of course, you have to stay within your range of expertise. You don't want to just start adding untested strategies that introduce new, uncontrolled risks.
That raises a really important point for long-term success and, frankly, psychological resilience. Markets change. Edges in markets disappear. Trends change. It's constant flux.
Always.
Successful traders, much like successful businesses, have evolved over time. Relying on just a single method can lead to significant failure when market conditions shift or strategies become overcrowded. Think about, momentum trading in tech stocks in the late 90s or scalping S&P ticks back in the day.
Right, those edges fade.
Yeah, your trading psychology needs to be adaptable to these external shifts, or you'll find yourself stuck trying to fit a square peg into a round hole, psychologically speaking.
So in essence, you as the trader, you are your own research and development department.
Yeah.
You're an entrepreneur constantly developing new strategies, new ways of building upon your strengths. It's not just about putting in screen time. It's about developing a pipeline of innovation to sustain your trading business long term.
And here's a powerful coaching cue related to that. Learn trading skills at time frames different from your own. Short-term traders, for instance, can benefit immensely from understanding the larger market themes that move the markets day to day.
Seeing the bigger picture.
Exactly. And conversely, longer-term traders can gain a lot from the precise market timing perspectives of a short-term trader. These views from different time frames can fertilize the search for new sources of edge and really broaden your strategic thinking, making you a more versatile and resilient trader overall.
Okay, that makes sense. Now let's talk about holding yourself accountable. Are you truly keeping score in your trading business? And we're talking more than just your daily P&L here. Think about successful corporations and their huge investments in information systems. As our sources state, knowledge utilized properly is power. This applies directly to managing your trading psychology too.
Absolutely. And what's incredibly insightful here are the essential metrics you need to track, but crucially, track them against your own historical norms. That's how you know when adjustments are needed. This includes your equity curve focus on changes in the slope compared against your typical variation, your winning versus losing trades. That's a basic measure of how well you're reading the market. You need to diagnose if it becomes atypical.
Okay.
The average sizes of your winning and losing trades reveal a lot about your execution quality and risk management discipline. Your average win-loss per trade measures the efficiency of your efforts. Sometimes more trading did not produce more profit, and being more selective can make this metric soar.
Less can be more sometimes.
Precisely. And lastly, the variability of your daily returns. This shapes your drawdown size and helps calibrate risk management. For example, if you want total drawdowns below 10%, you really can't risk average daily swings of, say, 2% or more. This data truly empowers your self-coaching.
This is where advanced scorekeeping really changes the game for your business. It means tagging each trade by type, maybe by instrument, market, the setup you use, the time frame, or even the market condition at entry. Each of these categories is effectively a product in your trading business, right? A potential profit center that you need to evaluate.
The power of doing this is just immense. It reveals which trading is most contributing to and limiting your results. It helps you play to your strengths and work around your weaknesses. It's like a football coach analyzing each segment of their team's performance, offense, defense, special teams to refine strategy. And it directly informs your self-coaching efforts, allowing you to focus your mental energy where it actually matters most.
That deepens the diversification concept nicely, bringing us to tracking correlations of returns. You see, just trading different setups or markets doesn't automatically mean you're truly diversified.
That's a subtle but key point.
Yeah, if your strategies are highly correlated, you're actually taking much more risk than you realize. And you're psychologically exposed to similar market shocks across the board.
Think of a car dealership selling many types of trucks, vans, and SUVs. It looks diversified on the surface.
Right.
But if large vehicles suddenly go out of favor, maybe because gas prices shoot up, the entire business becomes vulnerable. Our sources explain that correlations among your strategies and trades vary over time because of how markets trade and because of your own hidden biases. If those correlations suddenly soar, you're concentrated, and your risk of psychology shifts dramatically because you're facing greater hidden risk than you thought.
So to achieve sound diversification, you really need to blend different things, maybe different time frames, directional versus relative value trading, different strategies like playing earnings announcements versus opening range patterns in different markets altogether.
Yeah, break up.
This is where things like spread pairs trades really shine, as they can potentially work regardless of market direction, adding a powerful layer of true diversification to your portfolio. Okay, now let's talk about the importance of execution in trading. It's kind of like this. A great product marketed poorly probably won't sell well, right?
Right.
And a brilliant game plan ultimately fails without good execution on the field. It's what you do with the idea, and it's a direct reflection of your trading psychology in action. A trade idea fundamentally, is a hypothesis. It includes an entry setup, a profit target, and a stop-loss level. That crucial point where your hypothesis is proven wrong.
Mm.
Our sources state it very simply. The trader who lacks clearly defined targets and stop-losses is like the scientist who lacks a clear hypothesis. You're essentially just trading to see what happens, and that's not a sustainable business model, nor is it a path to strong mental discipline.
So true. Good execution, therefore, really emphasizes entering at a price where your potential loss is less than your potential reward. It's about risking $1 to make 2 or more. And critically, stops should be placed where your idea is wrong, not just at some arbitrary dollar amount you're uncomfortable losing.
That takes discipline.
It does, and this disciplined approach is a cornerstone of sound trading psychology because it forces you to acknowledge when you're mistaken, limiting that emotional attachment to a losing position.
And what about this idea of heat? Can you explain that?
Sure. Heat is basically the amount of adverse price movement that occurs while you're in the trade.
Okay, the drawdown while you hold it.
Exactly. Good execution generally means taking relatively little heat compared to the size of your gains. It's about getting in right, minimizing that initial stress and doubt.
Makes sense.
And the psychology of good execution is fundamentally about patience. It's like the poker player,
Yeah.
You want to bet when the odds are clearly in your favor. That means mucking a lot of hands.
Cool.
It's often about knowing when not to trade, which frankly is often harder than knowing when to jump in.
Definitely harder.
And here's a simple coaching cue that can help reduce heat. Wait for buyers to take their turn if I'm selling the market, and wait for sellers to take their turn before I'm buying the market. This helps you enter after potential short squeezes or big program trades have fleshed out, reducing that initial adverse movement and the psychological toll it takes.
That's a practical tip. Okay, let's shift our focus now to the proactive aspect of a thriving trading business, generating good trading ideas. Just like successful businesses continually innovate, successful traders must continually scout for fresh opportunity because, as we've said, market patterns are ever-changing.
Right.
If you just rely on one single approach, you'll eventually find yourself vulnerable, both financially and psychologically.
So how do you find these new opportunities? Well, one of the key skills of the best traders seems to be thematic thinking. They synthesize data across markets, asset classes, and time frames to generate trading themes. These are your narratives or your theories about the financial marketplace.
Like a story the market is telling.
Exactly. And your trades become tests of these theories. For example, a portfolio manager might short consumer discretionary stocks based on high gas prices and a weak housing market. That's a theme. Or a short-term trader might sell into resistance based on market profile analysis, volume patterns, and sector behavior. This kind of thematic thinking builds confidence because it's grounded in a broader understanding.
That's a powerful parallel. It really stresses the importance of avoiding a myopic view, doesn't it? Just staring at one chart.
Mm-hmm.
Understanding those intermarket relationships, how different sectors, asset classes, global markets interact, helps you see the real catalysts that move capital, rather than just focusing on isolated chart patterns.
And a powerful coaching cue here is to actively look for themes that stem from particular news catalysts. Track the leading sectors, observe how resilient they are on pullbacks. Many of these kinds of themes can run for several days, sometimes weeks, creating really great swing moves. It's about seeing that bigger picture unfold and trusting your narrative.
Okay, and finally, let's talk about managing the trade. This seems critical. Just as business success is so intimately tied to management, hiring the right people, managing inventory effectively, sticking to a budget trading success depends profoundly on what you do after you enter a trade and before you exit.
Absolutely.
It's not just about getting in, it's what happens while you're in the trade that often determines your ultimate profitability and shapes that psychological feedback loop.
And why is active management so crucial? Because, think about it, at the moment of entry, you actually have the minimum amount of information available to you for that trade.
Right, you know the least right then.
Yeah, as the market trades, you accumulate fresh data. That data either supports or disconfirms your initial idea. Ignoring that incoming data is like a business owner ignoring critical customer feedback. It's a key part of your ongoing self-coaching process during the trade.
This is where strategies like scaling into trades can be really useful.
Yeah.
You start with a small initial position, maybe, then add to it as fresh information validates their idea. This potentially maximizes gains from your good trades while incurring only small drawdowns when I'm wrong on the initial probe. It feels like an act of confidence based on evidence, not just blind hope or emotion.
And what's fascinating here is actively processing information during the trade itself. For example, monitoring sentiment indicators like the NYSE tick.
We mentioned that earlier.
Yeah, that tracks the number of stocks trading on an uptick versus a downtick. Watching that allows you to potentially discretionarily exit the position prior to hitting my stop loss level if you see sentiment turning sharply against you. This could save you significant money compared to just waiting for the start. But it requires a nuanced understanding of your own trading psychology and, frankly, the courage to act on new information, even if it means admitting your initial idea might be weakening or wrong.
Exactly. Our sources really reinforce this core idea. It is important to be right in the markets, but it is even more valuable to know when you're right.
That's powerful.
Successful traders don't just get lucky. They press their advantage when they know they're right, maximizing opportunity with conviction that comes from that accumulating data.
And perhaps a final coaching cue for you, the listener. Treat your trade management as if it were a separate profit center. Practice it in simulation. Assess your trade management. Ask yourself, do practices like discretionary exits actually add value over time? Make the most of your winning ideas by practicing adding to positions on paper or in sim first. This iterative process of self-assessment and refinement, it's absolutely key to long-term psychological and financial growth in trading.
Wow, what a deep dive indeed. It's really clear that successful trading isn't just about market predictions or, chasing quick profits. It's truly about building and actively coaching a robust, adaptable business with you firmly at the helm.
Absolutely. We've seen the vital role of having sufficient capital, the necessity of a data-driven business plan, the protection you get from true diversification,
Mm.
the power of precise execution, and that strategic edge you gain through thematic thinking and active trade management. Each element is really a building block for sustainable success.
And crucially, let's not forget the psychological impact of all this. Managing your trading like a business effectively, with solid data and clear goals, it helps you cope with those inevitable lean times without completely losing hope.
Right.
And it helps prevent overconfidence when things are going really well. Matching your portfolio risk to your personal risk tolerance isn't just about the numbers. It's a huge step towards sustained success and achieving genuine peace of mind.
So maybe consider this provocative thought for your own journey.
Right.
What would truly happen if you began to treat your trading less like a gamble and more like a carefully managed enterprise? Complete with its own R&D department, meticulous accounting, continuous product development. What new opportunities, what new levels of psychological clarity, and maybe even breakthrough might that fundamental shift in mindset unlock for your journey as a trader?